second. Welcome everybody. Thank you for joining. I really appreciate having you here today. We're talking about real estate investing basics. So we're going through a 6-part series and we are talking about 5 different types of real estate and going through the basics of them. What are they? Good question. So the first week we started with wholesaling and flipping. We talked a little bit about that, the benefits, pros and cons of flipping and wholesaling as an investment strategy. Second, we're talking about REITs this week, a real estate, over 4 units and more. Thanks for coming back. We were talking about the different types of real estate investing. 1 is going to be the flipping and wholesaling. 2 is going to be the REITs, the real estate investment trusts. That's what we're talking about today. 3rd is going to be your small deals. That's going to be more of the stuff you can get with the residential loan. We're talking multifamily. That's going to be 1 to 4 units. It's going to be your single family homes, townhomes, condos, things like that, up to duplexes, triplexes, and fourplexes, which you can still get with a residential loan. And then we're going to talk about the 4th one, which is going to be the bigger deals. That is stuff that you need a commercial loan or some type of special loan type. That's going to be 5 units in the multifamily or more. It's also going to be your office, multi-use, and commercial buildings. And then our last one, the 5th one, is going to be syndication. That's where we're using other people's money. We're raising money and we're managing the deal or buying into a deal, grouping that money so that we can get a bigger deal that cash flows and makes more money. So that is the 5 different types of real estate investing. That is the basics. So today we're talking about REITs. What is a REIT? What is it? Where does it come from? What are some pros and cons of it? So a REIT is a real estate investment trust. That is what it is. It was created back in the 60s by Congress as a means for the everyday person, the average person, to be able to take advantage of some of the multifamily investment income producing properties and some of the kind of tax benefits that the IRS gives out for those properties, and just the investment side of it. It allows the everyday individual to get into those properties. And what is it? So before we get into what it is, the investment trust, we're going to talk about the different types. So there's 2 different main categories of REITs. And what that is going to be the equity side, and we're also going to have the mortgage side. And what we're looking at is with the equity side, that's going to be the REIT, that's going to be the group of properties, is going to be more of the mixed use hotels, commercial properties, multifamily, and things like that. And where they get most of their income based from is from the income that is being produced by those properties, meaning with hotels, it's going to be those daily rates. With multifamily, that's going to be the rents coming in, same as the mixed-use office building. It's going to be the income produced monthly from those properties. Whereas the mortgage category is going to be more geared towards the interest earned off of the residential mortgages or the mortgage-backed securities on some commercial buildings. So that's the main difference between the 2 big categories. It's going to be your equity and your mortgage. So that's where the income is coming from. That's how they're classified. Now there is a couple different types as well, though most of those being, are they publicly traded or are they privately held? Now a REIT, it's more like a stock. When Congress formed this, they did so into the format of a mutual fund. So anybody can go buy shares or stocks of this real estate investment trust. It's traded and treated like a corporation with shares in it. So you can go buy it like you could with, an Apple stock if it's publicly traded. So that's what a REIT is. It's publicly traded, it's recognized as a corporation, and they create shares of the real estate, and then they sell those shares of the real estate, and it's publicly traded. They use the funds from the buying and selling to invest back in and get more properties. So that's what a REIT is. Now, what are some of the rules? What is something that classifies it as a REIT? So we already talked about it being modeled after a mutual fund, right? We talked about how they are bought and traded. We talked about the private versus public and how they can be traded as stocks. We talked about how they're treated as a corporation and how they're held by the shareholders, just like a publicly traded company like Apple or Amazon or some of these others that we had mentioned. They are private-owned real estate for the long term. So what they're doing is they're holding real estate investments for the long term to drive the income off of those. And they must primarily own or finance real estate. They do hold other entities and other things in their trusts. However, they must mainly remain to be real estate minded. 75% of the earned income must be from real estate backed assets. And what I mean by that is going back to they must mainly be made up of real estate. They can hold other entities, companies, and other things in these trusts. But 75% of the income coming from the REIT must be from a real estate asset. Also, 95% of the income coming into that real estate trust must be passive, meaning coming from real estate. So those other entities, other companies inside that trust, they really have to take a back seat, if you will, because most of that money coming in has to come from the real estate assets. So these are formed and made precisely for holding real estate, allowing people to invest in and letting the everyday person get in on that. Also, we look at 90% of the taxable income coming into these trusts must then go out as a dividend to the shareholders. So only 10% can be held in those trusts. So 90% of that money must then go back out to the shareholders. Also, there's a minimum. There's a minimum. So when you buy in, when you have shareholders, you have to have a minimum of 100 shareholders to really start a REIT, to really start that real estate investment trust. So there is a threshold for how small of a corporation and how many properties and how many shareholders you can have inside of that. Also, it's one of the IRS rules and regulations is that 50% of the REIT cannot be held by less than 5 people or less than 5 shareholders or entities. And so what that's trying to do is keep people from buying in and having massive shares inside these REITs. Again, they were made by Congress to be like a mutual fund and to let the everyday person get in and have some of the benefits of investing in income-producing assets. So, what does that mean for you? What does it mean? We've defined it. We know what a REIT is. We know where the money comes in, how it goes out as dividends like we talked about. What does it mean for you? Well, is this the investment for you? We've talked about in previously episodes about figuring out what it is that you want to do, what it is that your goals are in real estate investing. If you've decided to invest in real estate, you really have to figure out, hey, do I want to play the small game? Do I want to diversify and get in a bunch of different places? Or do I want to control the deal? Do I want to manage the deal? Do I want to have a place in the deal where I can actually go to the property and have control over that? If that is the case, then a REIT isn't for you. Because when you buy into a REIT, I can't say, we have a building here in town and it's part of the REIT. If I buy into that REIT, I can't go to that building and say, hey, we need to paint the walls in here. We need to redo the lobby. We need to do this and that, right? Because you don't have that control over that deal. You only have a small ownership, and it's not a managing portion of that deal. So if that is you, if that is what you're looking to do, to control and manage the deal, then REIT is not for you. If you're looking to just have a little bit of passive income coming in the door, and you're looking to invest a little bit here and there, and not too worried about the asset, the deal itself, then this is a great opportunity for you. So if that is true, maybe look into a REIT. Contact me if you have any more information. I would love to talk to you further about this. Again, we're here every Thursday. We're talking to you about real estate investing basics. Every Thursday around 12:30 Alaska time. Next week, we're going to be talking about small deals. That's going to be 1 to 4 units as it comes to single-family homes, duplexes, triplexes, and fourplexes. And all of those you can get with a residential loan like you would just for a single-family home. So there's some really good info there. I'm excited to talk about it. I can't wait to share that information with you. And it's a really good entryway for a lot of people getting into their first income-producing asset and starting their multifamily investing career. So I can't wait for that. Look forward to it. I can't wait to meet you. Again, if you have any questions or anything, Matthew@precisionhomegroup.com. Also, 907-302-1011 is my cell phone. Feel free to call or text anytime. I would love to talk to you. Also, put some comments on here. Share. Let me know what you're thinking. If you agree or disagree, I want to hear about it. I love to debate, talk to you, and see where you're at with your investing and see if I can't help you out. Maybe I can learn something from you as well. You guys have a great day. Look forward to talking tomorrow.